Phil Streible. He's joining us from Blue Line Futures live from Chicago. Phil, welcome to the program. We saw the VIX at 28, U.S. earnings season, infotech dragging. What's the hallmark of the session, on Thursday that we can take away and help form our view of where markets are likely to go?
Well, I think there were two main issues. I mean, you look at the jobs number that came out in the morning. You've got a new 1.3 million claims that came out. Continuing claims are continuing to grow. You've got the pandemic unemployment insurance that is growing as well. So if you look at it, if there's no jobs, there's no profits from these companies. This is where it's going to weigh into the market. And I really think that Netflix was a wake-up call. That was a big drop. I mean, if you own 100 shares, you're out $6,000 when you wake up tomorrow morning when the market opens. So people are now starting to rethink things, canceling some of these unnecessary costs, and that's where forward guidance comes down, and I think the equities come down with it.
So you don't think that investors at the end of the day will be in a very forgiving mood if there's very vague forward guidance, which is what we're expecting from corporates this time around?
The whole thing plays on forward guidance. So if you look at Netflix, like what is their forward guidance? Did it go down because of the fact that people are like, hey, I don't need Netflix anymore. I'm going to go out and ride a bike, go fishing, go do things? No, the reality is that they are thinking like, hey, this is getting tough out here. The jobs picture is not good. People are getting laid off still right now. And you are not getting another job, not for a while. And you're probably not getting one until next year. So I think the jobs picture is bleak. I think corporate earnings is very bleak as well. And I think that is going to weigh in on the equities. And the thing is, you look at all these other companies like Peloton and, companies that have just blown things away. People are going to tighten up their belts, and those forward guidances are going to come down.
Well, why did, in this environment, this risk-off environment, you think we saw gold a tad lower?
Well, I mean, look, gold, the price is pulling back, the volume is a little bit weak, and volatility decline. Those three things, when they add up, that is a buying opportunity. The reality is that, we are going from safe haven demand, it's going to go into inflation demand. And people that don't believe inflation's not there, look at medical costs and look at your grocery bill. Those things are continuing to go up. You're going to see gasoline prices continue to go up. And the only reason why we got hit on gold was that the correlation between the dollar and gold, if you go 30 days ago, that was about 16%. They were moving together. Now, all of a sudden, they got an inverse correlation. So the one day you get gold popping up just a touch, you're going to get that pullback. That pullback is a long-term buying opportunity, and I really think you got to stick with gold specifically and avoid things like miners and other speculative assets out there.
Yeah, you must have been listening to our previous conversation with our previous guest. So when we talk about what you're looking forward to learning next week, that will help you determine, where you again continue to see the direction of the market. We've had all these Fed speakers out this week reaffirming that they're willing to do whatever it takes to help prop this market up. Why would anything significantly change when you know that we've got the Powell put behind us?
Well, I mean, I think that's just crazy. What kind of game are we playing here? We're not, there's no earnings out there. You look at like a cruise line. How can we go on a cruise right now? They don't exist, but yet the stock prices go up in value. It just doesn't make sense. So, unless they get another round of injections of stimulus measures and, more money being thrown at it, yeah, that's going to continue to support the market. But the reality is once that gas pedal is let off, that's when we start to fall. You got to look, though, it's not President Trump. He's President Pump. He's trying to pump up this market here, and that's what he's doing. So he's got a lot of pressure on the Fed because his election is completely involved with it. You go out to that level, after the election, that's when things, I think, start to change and reality sets in.
Okay, and you brought the election up. So are we looking at a second term for President Trump? Will the market get real jitters if we start to fully, expect a potential Biden presidency?
Okay, so I'll give you some good information on this. So they say that right now Trump is trailing by like 14%, right? Oh my God, he doesn't have a shot at all on winning this thing. The reality is that the popular vote doesn't win in the United States. It's the Electoral College. Yeah. So you go to the 10 states that are the battleground states. He's not going to win Illinois. he's not going to win California because in the populations are pretty dense there. Okay, you go to these battleground states, he's only trailing by a few percent. And the reality is if you go to one of those Democrat states that are a battleground state, that's where the silent majority comes in there. So I think the election is a lot closer than what you think. I think that people, they're mad at Trump right now. They're not disagreeing with his policies. They're just mad at him. And it's a lot easier to get somebody who's mad at you to change and all of a sudden like you again by apologizing and acknowledging some of the things that you've done wrong rather than changing a policy that people hate. So I think he's got a really good shot. I think it's a 50-50 chance, and, we'll see what happens.
Yeah, well, we'll be talking about it between now and then, Phil, no doubt. Have a good evening there in Chicago. Enjoy.
Yep.
Thanks for joining us. All right.